Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Phil, welcome back to the podcast, mate.
Thanks for having me.
It's always good to chat. This is episode 4 of our insurance series and personal insurance series, if I'm being precise. So far, we've talked about lump sum insurance, income protection, and we provided a broad overview of what we're talking about and why it matters. Instead of, say, just health insurance or car insurance, why this is such an important area of people's financial lives. And if people want to work with your team, they can go to the link in the show notes to do that. It's what I'm doing at the moment. So I'm going through the process. So this one is all about how do people pay for their life insurance, TPD, trauma, income protection, child's cover. How do people actually pay for that? How can you structure? What are the options that are available? Some people know you can use super for some things. We're going to talk about all that. Now, you guys crunch a lot of data. You get some industry stuff. Your LinkedIn has ideas about maybe better ways people can make informed decisions around how the industry can operate, like you're the guru of this sort of stuff. But I want to start by asking you a personal question, which is, what insurances do you hold?
I've got all of them. Yeah, I hold them all. I'm currently increasing mine. My lump sum covers, life and TBD, I'm increasing mine.
Okay. Do you use Skye yourself?
Yeah. Well, I set it up when I wasn't at Skye, when I was working for another advisor, and then we look after the policy. So yeah, my team are helping me increase my cover.
That's good. Yeah. So that's good to know. He eats his own cooking, which is really important. Now,
on that, I actually we have a in-house philosophy in terms of the level of cover we recommend for our clients. I have heaps more cover than what we would recommend me if I was just a straight client. One person's under insurance is another one's over insurance. And so we understand that it is difficult, that the level of cover is very personalized to one person. And we have a house view of the way we think about stuff. But for me, the reason why I theoretically over-insure myself is because I know that the cost of the cover versus the downside impact of me or my wife passing away is a really easy value proposition for myself. I know that I'm paying a few $1,000s for my cover, but if I died and, our future, growth plans, our future wealth creation plans are going to be nothing if I died or if I was disabled. So I want to make sure I've got more cover than the insurance companies are willing to offer me. The reason they do it is because I get grumpy at them and yell at them and say, please give me this much cover. But yeah, if I was a client of ours, I would be recommended much less than what I personally have. So not only do I eat our own cooking, I gorge on our own cooking, if you will. Don't know if that made sense.
Yeah, no, that makes sense. It's interesting because in your line of work, you and your team are specialists in insurance and life insurance and income protection. Typically, you deal with clients at two ends. One is they're setting these things up and they listen to this podcast and they come to you guys and they set up. Happy days. But on the other end, there's claims and there's people that have their life totally turned upside down in some situations. And if you're working at the coalface for long enough, I'm sure that leaves an imprint on the way you view things and how you value certain things. It's like, when you ask a doctor whether or not you should do something, it's typically like, yes, because every day they're dealing with people who get sick from that thing or whatever the case may be. So exposure is definitely something that I think may play in without giving you a diagnosis, of course. So high level, what are the different ways to purchase the insurances? And we've covered them before, but there's life insurance or death cover, TPD, trauma, child's cover, and income protection. Those are the big ones that we've talked about, and those are the big ones. What are the options?
Yeah, so if you want all of those, there's really only two options. You can go direct to the insurance company, and there's only really two insurers in the market who I would personally get cover through. Or if you don't want trauma or child's cover, you can go through your super fund to get it. And then the third option is if you want all of it, you can go through a financial advisor to help set it up. And so the differences between them all, direct is my least preferred, I guess, unless it's those two insurers. There are limitations on the cover. There are limitations on how you can fund it, which we'll talk about funding mechanisms as well later. Going through your super fund is my second least preferred because it does limit that you have to be funded through the super fund. And there are limitations when it comes to the quality of the product. So a quick, simple example is if you're on parental leave while you have a claimable event, your income protection may not pay you anything, even if you've had an income before. But if you've gone through a financial advisor or some of these direct products, then they can still offer you an income protection payment at claim time. The other thing is if you're not gainfully employed at the time that you need to claim on your TBD or income protection, then you may not be able to get anything. So you may be paying premiums for a whole bunch of years and not get paid anything at time of claim. So there are some strict rules, and that's purely based on the superannuation legislation makes it really difficult for us to take any money out of super. So they're kind of the three different options: direct, through a financial advisor, or through your super fund. And there are other group covers. So your employer may offer you cover, but you generally can't increase it or change it. It's just whatever you're offered through your workplace.
So while you was answering that question, I was going through to a LinkedIn post that you shared 3 months ago, which is it uses government data, and it shows all of the different things that you would assess for an insurance company or organization, things like the number of claims that they actually accept, the time it takes them, the number of disputes, the policy cancellation rate. And you know what I was trying to do as you were talking through that is like, if someone was going direct, I was trying to figure out who would be the two that Phil says you could go with versus the rest that maybe not. But you don't have to say, but I was just like, that was something that's really interesting to me. Now, obviously, if folks are listening to this or watching this, they probably want to make sure that they're not going to end up one of those situations. Like based on the industry data that you shared, the difference between good and bad it's not like 2 or 3%. Like we're talking like a significant difference between what it looks like a good insurers and what it looks like a really poor insurers. So I can only imagine the people that got stuck with those ones. Can you talk through some of those claim stats, just generally speaking, or like how you analyze the industry? You don't have to, if you don't want to, you don't have to name names, but if you want to name names, just
have a go. So these industry claim stats, Money Smart website, which is a ASIC website, like a government website that they provide. So Money Smart, you can just Google Money Smart insurance claim stats, and it'll probably be the first link. So that's the insurance regulator, APRA, provides data every 12 months. So it's a 12-month window on claim statistics. Now, on my LinkedIn post, I actually had a bit of a whinge about why don't they show the average claim amount, because that's the most important thing. Yes, claims acceptance rates is very important, but the average claim amount from a super fund, I looked at this the other day because I got my team to write some of this stuff up, but like it's the average claims rate, for income protection through an advisor, the average claim amount is $8,000 versus through a super fund, the average is $4,000 per month. And then go to the next view. So that's the average claim from a financial policy set up with a financial advisor. The average claim amount is $510,000 versus super funds. The average claim amount is $134,000. And then TPD is the next one. The average claim when you set up a policy through a financial advisor is $664,000 versus $145,000. Now that level of cover, you can choose that level of cover. So you're not stuck there. But that's really important to understand the claims average claim payment for these different types of policies. Now, the claims acceptance rate is another thing. My only issue with those is it's a 12-month window. I'd love APRA to extend it for a 5-year window to get more statistically relevant numbers. Like having a 12-month window, especially for TPD, because we introduce a lot of insurance to insurance companies, we get to get on the phone and we ask them directly, explain why your acceptance rate's low, and some of the lower ones that anyone can go and check out. The issue with TPD is the actual number of claims is often very low because it's really unlikely to be claimed on. So even something that gets claimed on but is completely not eligible because the client is not TPD'd, they still need to mark it against their claims acceptance rate. And so if we're talking about a window of 30 claims for TPD, 5 of them are legitimately should be declined because they're not reasonable claims. Someone's done their ACL, so they shouldn't be getting a TPD claim. They've got to mark that against their claim stats. So that's kind of the pro-insurer version of it. And my argument is I would love APRA to show a 5-year window because then we get more statistically relevant numbers and averages over time. But income protection, life insurance, there's lots of claims amounts, so the acceptance rate's really important. Again, I would love better data in terms of the reason for declining or the reason why claims acceptance is accepted or not, because again, I could go to my insurer and ask for an income protection claim but be totally fine, and they should decline it, but it'll go against their numbers. So that's kind of the only issue with the APRA stats, but it is relevant. The other thing to look at is policy cancellation rates is actually super important to consider. What that means is what percentage of their policies are they losing every 12 months? The high number, the worse it is, and the less sustainable that insurer is.
Wow. I'm still just blown away by the numbers that you're talking about.
Those average numbers?
Yeah. Because if someone is getting TPD through a financial advisor, let's use this as an example, the average is 664,000. But if they get TPD through a super fund, it's 145. That is a humongous difference.
Yeah. And if you look at these numbers, let's double click on this. So go back to that TPD number. So the claims acceptance rate through a super fund is 92.5%. Now go back one versus through a financial advisor is 83%. So the story in those numbers is, why do I go and get a policy with a financial advisor if my claims acceptance rate is going to be much lower? And that's a reasonable question to have. And that's why, and the reason why I provided these average claims numbers is because most super policies are set up automatically when you join the fund, and there's no medical disclosures around that application, and there can be no non-disclosure issues at claim time. So if you are eligible, you will get paid out a claim. But with a financial advisor, because of the higher sums insured and you've got to go through an application process, you've got to do medical disclosures. I may have a mental health disclosure on my policy, and if I can't work for mental health and I still claim on my TPD, they'll decline that, and reasonably so, because I've got an exclusion on the policy. So that's why the acceptance rate is higher for some of those policies with a super fund than compared to a financial advisor. But when you overlay the actual understanding of the different policies and how they're set up and why they're set up the way they are, it can sometimes make sense why claims acceptance rates are higher for certain different policies.
Right. Well, that all makes sense because they're probably more important, as in like they're more detailed in terms of the policies that go through the advisors.
And again, and this is why, I mean, I'm a data geek because I think numbers tells a story, but it's also like depends on your point of view, what story you want to tell. You can use the numbers to tell that story. And so that's why it's so interesting to try and look back and understand I'm a financial advisor. I'm biased. I've got a horse in the race. I want to paint a picture that advisor policies are better for a whole bunch of reasons. But just purely looking at claims acceptance rates and going advisor policies for TPD are bad and super funds are good doesn't tell the whole story.
So the narrative I'm going to say is a lot of people have default levels of cover in their super fund for things like life insurance, TPD, and sometimes income protection.
Correct.
don't, or probably do anyway. So those three that are paid through super tend to have higher acceptance rates because there's really not as much stuff that goes into assessing anyone's cover.
Yeah.
But the amount is so much lower, and it's probably not appropriate for most people.
That's right. And like you think commercially, like I'll name some super funds. So Hester, they historically had $950 per month in claims payment for income protection, and sometimes it only lasted for 2 years. So from a business point of view, if I'm an insurer, am I going to invest 30 hours of my claims assessor to determine if we should pay out that claim or not? Because it's going to cost me much less than $950 just to pay out the claim. So from a business point of view, I'll pay out that claim much quicker because it's the cost benefit. It makes sense. But if I'm on risk for $1 million, or $8,000 until age 65, we want to invest our time in making sure that claim is legitimate and fair and reasonable. And so the commercial decision won't be just pay it because it's cheaper to pay it than not to pay it, because the sum's insured higher. So there's a whole bunch of those things that do come into play that just, and this was kind of my issue with that post, and the reason why I posted it was because I would love APRA to show a broader picture on claims data, because, and not that advisor policies always looks worse on claims data, it actually doesn't, but it just paints a picture, a broader picture when you use, and it's all in the same data set APRA use, they just display it differently on Money Smart website.
So, okay.
We've gone deep.
No, that's fine.
Bring us out, Owen, bring us out.
So, no, because I'm thinking, right, like if people could be caught in a trap here, because they could be like, well, I need more than 130, whatever the $1,000 it was, because you probably do. If you've got responsibilities in your life, like almost every single person listening to this would have some financial responsibility. But then if you go to increase the cover, then there may be, like, there's obviously like checks and balances that, like, you got to fill in questionnaires, or you got to do a full medical, depending on where you go to and the level. But that's going to get really expensive really quickly, which is to your point from a few episodes ago. And the thing that I was going to bring up in the next episode, I think it was, or the one after that, it was for the adjusted cover. I currently have like 1.27 million for life/death cover in my super fund. And my income protection is like $6,000 a month, which, to be honest, is not enough, particularly if we go to one income. So I need to think of like other things, hence getting your team to look at it. But I'm probably like an exception, because I'm like 10 times looks like the average. So for my life cover. So for me, even though I have the cover, there may be other things that come in. I may be paying more. I may get a claim denied if there's something that I missed, or that whatever process wasn't correct. So realistically, even though super may be a good means to pay, it still probably doesn't make sense. Well, obviously, to get an expert to review it.
Yeah, I mean, the funding of it is, whether you go through your super fund or whether you go through an advisor, both can be funded through super anyway. So if you said to me, Phil, I only want my super fund to pay these premiums, then great, we can set you up a policy with any insurer and get Australian Super to fund it still, and that there's no issues with that. And so sometimes there's this question of like quality of cover and the type of cover, and the funding can be very different. Most people link them together. It's either I go to my super for my super fund to pay, or I pay it all personally. So that's, again, back to one of my earlier myths from, I think, episode 1 is you can set it up, get your super fund to pay for it when you're set up through a financial advisor. But one of the questions I would ask you to deep dive on your situation is you mentioned that you didn't do any medical questions at the time.
I think I did. Like, here's how I'm going to characterize it. I would describe it as like the guy that was on the couch from, like, you made that analogy a few episodes ago. I was probably that guy. I didn't do the full medical. I did like here's 10 quick questions, figure it out kind of thing. And I went through and like, bada bing, bada boom, But now I'm thinking, holy shit, did I miss something? And if I do go to claim, was younger Owen sensible enough to tick all the right boxes? You know what I'm saying?
Yes. From my experience, when people have increased, we've seen a lot of non-disclosures with increased covers. Now, we are big believers in holding. If you've got existing cover, our business is very big believers in don't touch it unless there's a really good reason to touch it. We don't, because moving policies just creates risk. Anything prior to that policy starting from a health point of view will be covered under that policy or not covered, whether you disclose it or not. So that's why we have a very big belief in like try and keep the cover you've got. And if it's not enough, do we need to increase it or change it? But if it makes sense to move, we'll move it. My question to you, and I'll give you an example and an experience that we see a lot. Australian Super, if you made a mistake with your original disclosure, Australian Super, from my experience with our clients, they won't allow you to update that disclosure to make it true and correct at that point in time. They will let you update your disclosure, but it has to be as of today. And again, I'm not trying to call any super fund out or insurer out, but that's been the experience is we've noticed non-disclosure and we've gone, and so there was an issue back then prior to that increase and then an issue since. And we've gone, can we just update that disclosure to exclude that first condition, but not exclude that second condition? And Australian Super have come back to our client and said, no, we can't do that. It needs to be a fresh new disclosure on your medical history as of today. So the issue I've seen so much is when people have increased it, have they just done something that they thought was right because they just half read it because you're sitting on your couch and it makes sense why it's easy. But at claim time, Australian Super is not the insurance provider. The insurance provider is another third-party company. They're the biggest insurance provider in Australia. They do not care who Owen is. They don't actually care that it's Australian Super. They will assess you if you disclosed accurately or not at that point in time. So you can, again, what I would do if I was you, and what we would probably recommend you do when we go through your proposal, go back to Australian Super and ask for that personal statement is kind of the word they'll probably understand, or medical disclosures. So they'll have it on file somewhere they can send you, and then you can look at it and go, was that true and correct as of that time? If it is, happy days. If it's not, we've got some problems.
Yeah, this is something that freaked me out. I was chatting to a financial advisor over in Perth not too long ago, and I was like, yeah, and this is what I got in my cover. I'm pretty good and I'm sweet. And he's like, if you made one mistake on that original document, you might pay that premium for 10 years and they might deny you, even though you paid for it. And I was like, what? They can do that? Because it's kind of like normally in consumer land, if you pay for something, you get the return from that thing, right? Like you pay for car insurance. Here's my car. I crashed it, I get the non-disclosure thing. But there could have been some really quick and easy things that I missed. And in the grand scheme of things, it might not be that big of a difference, but on a technical basis in the T's and C's, yeah, the claim could be denied.
Correct. And a big example that we see a lot is mental health questions. So mental health questions, the way it's always written is, have you had any mental health symptoms, diagnosis, symptoms, or treatment? Or sometimes they'll use the word symptom at the end. So it's like a catch-all on mental health. And most people read it and go, no, never been diagnosed. But hold on, you've had symptoms that you've spoken to a GP about anxiety, depression, whatever it may be. They're all very normal things that you talk to a medical practitioner about, that's on your medical file, that you told the insurer that you had no symptoms. And that's where we see big issues arising. And it's kind of like these, issues that hopefully you never claim on the cover, so it's never going to be an issue. But if you need it, you want to make sure it's there. You want to make sure your disclosures are done properly and accurately at the time that was true and accurate at the time.
Okay. So, I mean, I know I've got to do all this stuff. Like I know that's why I'm going through the process, right? And because we're a couple and I'm self-employed, I know, blah, blah, blah. There's so much I've got to do. Fortunately, your team have helped me through this process. But, okay, this episode was about different ways to purchase insurance, different ways to pay, right?
Yeah.
Generally speaking, do you find a lot of the Skye clients pay for things through super if they're in like accumulation phase, like working professionals, younger people? Do you find that that's the case?
Yeah. So the policy, you can pay for income protection, life insurance, and TBD through your super fund. Life and TBD makes a lot of sense to pay through super. The reason being is because your super fund will get a tax deduction for that, assuming you're with a super fund who refunds that tax deduction, but that's for another day. But you can pay 15% less for those premiums. So when you set it up with an advisor, the premium might be $1,000, but that your super fund, Australian Super, will only get deducted $850 from the super fund for that $1,000 premium. So that's why life and TBD makes a lot of sense to pay through super. Now, again, the ongoing premiums have a tax considerations, but the claim also has a tax consideration, and TBD can potentially have a tax on claim, which at Skye we factor in. We think about what is that potential tax going to be, and we gross up the level of cover to factor that in. But without getting too over the top, it's 15% cheaper to pay your life and TBD through your super fund. Income protection, you get a 15% tax rebate in your super fund, but income protection is tax deductible. So depending on your marginal tax rate or the tax that you pay, you may get a tax deduction for that income protection policy. So again, if you own it through the super and pay for it through the super, but you contribute to the super, it'll be the same net tax benefit as if you paid it personally. So you can make it the same from a tax point of view. And trauma insurance can't be funded through super at all. Child's cover can't be funded through super. So it doesn't matter how much super you've got. You've just got to pay those premiums personally.
Okay. So income protection, it depends. Like depending tax situation, depending on probably your cash flow as well as the family unit.
A big thing is cash flow. A lot of our clients, they sometimes just choose to pay that income protection through super. If you've got a young family, cash flow's tight, you can hold it through your super fund. And then the great thing about your super fund paying for the premiums is you may not have the cash flow today to pay for it, but in 3 years' time, you can make up that payment because you can do super contributions to make up the payment.
That makes sense. Child's cover, need to do that out of your own pocket.
Yeah.
Trauma, need to do that out of your own pocket. Just for people that have never had trauma, or I've never had child's cover. Like, obviously, it depends. It's nuanced, as you would say. But generally, like, what is the figure that people could have in their mind? Like a range of, like a reasonable range. Yeah. In terms of like the cost, like the monthly
the cost that's the only cost I can kind of give you a good range for. Everything else depends on your occupation, your age, sex, but child's cover is kind of the one figure that's easy. Basically $15 a month for $100,000 of cover. You scale up or down if you want less cover, cost you less. If you want more cover, cost you more. And you normally capped out at like $250,000 is the maximum amount of cover you can get.
Per child.
Per child, yeah.
Yeah. Huh. That's pretty reasonable.
Yeah. And trauma, like there's heaps of different things, but the great thing about insurance, and this is another like big takeaway, is insurance, for personal insurance, it's not just a do I take it or do I leave it? It's kind of a do you take it or do you take it as much? Or do you reduce the benefits? Do you change around the features? There's so many levers we can pull when it comes to premiums that it's not just a matter of keep it or cancel it. It's a matter of keep it, reduce it, or cancel it. They're or increase, I guess, is the fourth option.
Interesting. Very interesting. So has there been anything else that we haven't talked about in this episode, Phil, on the things that we want to talk about? So the different ways to pay for insurance. I would encourage people to treat it like it's like health insurance, which you pay anyway if you're over a certain amount. Like there's a benefit that comes, and most people, I would say not most people, I say a lot of people who listen to this have private health insurance. So think about it as like a necessary thing that is really important to your family. But what else? Is there anything else? I'm going to ask you for your action points, so don't give us that yet. But anything else?
The only other thing I was going to touch on, and we mentioned it briefly in episode 1, is like the cost of cover.
Yeah.
So generally speaking, now we did talk about some of our stats internally. We did a report where we just basically went, I just want the last 500 clients. I just looked at the 500 clients who did the fact find, which is our information gathering document. And I just basically literally just did a 500 clients. We didn't self-select. We didn't try and cherry pick any of these numbers. We've got specific dates, and we're creating a report to try and make it more scientific. But basically 500 clients, we fully quoted them and gone, what's the cost of cover with their super fund that they're with versus the insurance provider that we recommended. And out of those 500 clients, I think we got a data set of 490 something. And it was over 30% more expensive to go with their super fund. I think there was, again, I've got these numbers in my head. I don't have them in front of me, but I think 83 of our clients were with Australian Super, and it was 45% more expensive with Australian Super than with the advised policy that we recommended. And again, we don't actually recommend the cheapest all the time, because if someone's going to offer a mental health exclusion and another one isn't, but they're more expensive, then we'll recommend that more expensive product. There are super funds that were statistically cheaper, had a decent data set, but they were cheaper. And there are some clients that with Australian Super who their policies are cheaper. So it's not a blanket rule. If you're with Australian Super, move, or if you're with Aware Super, who was actually 7% cheaper, if you're with Aware, keep it. It's not a blanket rule, but it was really interesting to see that data set, because we see it every day. We do all the research, but I just wanted to try and make it as statistically relevant as possible without. We got basically 3 of our associates doing a whole bunch of this work. Just to
lucky them.
Yeah. It was like, welcome to the team. Here's a month's worth of work. And so we didn't compare any of the direct products. Often direct are even more expensive because their attrition rate for those policies are really low. They churn out of those policies if you're buying direct versus super or advice policies. But yeah, that was our data set. It's not perfect. Our client data skews younger. When we do have the report, we're going to kind of talk about all of the failings with our data set, like our client ages and occupations kind of skewing. So it's definitely not a case for everyone. It's always going to be more expensive or cheaper one way or the other. But it does show that advised policies that have inbuilt commissions in them aren't more expensive, which we've always kind of been told is the case.
I think the big takeaway for me on that is that anyone that's probably in my situation, not calling out Australian Super, they're the biggest, but we didn't come in today just to beat up Australian Super. But people that are in my situation, they were like, I'm going to do the right thing based on that Rask podcast I heard and increase my level of cover, because I have 2 kids and $130,000 makes no sense for my life cover. And then gone into your Super app and increased the cover, answered some questions. Even if you got all the disclosure requirements correct, there's a big chance that you're paying more than you need to. So that's my big takeaway from this. And that's one of those things. There was another one that I've completely blanked on, but you mentioned something before, and I'm going to try and figure it out before the end of the show. At the end of these episodes, I do ask you to give us one action point, one takeaway, one insight, one thing to remember, one thing that after we hit close on this YouTube video or after we hit next podcast, before that moment or after, between the next one playing, what's one thing that people can take away from this episode?
It's a great question. I would say I didn't prepare for this one, is what I would start with. Okay. The takeaway is, I am so skeptical. I would just say question everything. And if you go to an advisor and you come and speak to us, question everything. Like our documentation, our advice documentation, we show you a quote comparison because we assume that, I'm just a skeptical guy. I just think everyone's out there to do something dodgy. So I'm like, So we add those claim statistics in our advice document. We want clients to see. So if we're recommending the worst on claims data, ask us about it. Question us. Talk to the advisor about why have you recommended this if their claims data is so low or whatever the case. So we include all of that in our advice document because we want to educate and empower people. So that's kind of my thing, is just question it. Just ask, is this necessarily true? If this is kind of just a thing that I've been told and thought about. Because the reason we did these 500 client data to show that super funds currently are more expensive on average than advisor policies is because there is an assumption and a myth that that's not the case. And so that's kind of my takeaway. Just question any assumptions that you come into, whether you're going direct to the insurance provider, whether you're going through a super fund. Maybe just don't assume that everything is exactly what it is.
Fair enough.
I'll go one more.
Go for it.
If you've increased your cover through your super fund, go and call them up and ask for your personal statement or medical questions and just double check those disclosures are right. That's actually a better answer.
Okay. So at the time that you did them, were they correct?
Correct. Yeah.
So personal statement, or what was it called? Medical questions.
Yeah, just medical questions. Like they will just basically say, when I increased this cover, did I answer any medical questions? Can you please send me a copy of them? And they'll have it on file.
Okay, that's good. I actually realized the question I was going to ask you before, which is more tongue in cheek than anything, actually. The question I was going to ask you is, what insurance, you're like an insurance guru, right? You just do personal insurance for your business, right? So like life, income protection and stuff. But what insurances, are there any insurances you don't have? Like, I'm thinking like pet insurance or like other types of random things that people say are insurance. Are there any things you're like, nah?
I have third party car. Oh no, do we have comp? No, we just got comprehensive because I got a new Tesla after you told me to get one. I don't have hospitals cover.
Oh, really?
Yeah. I've done the sums. We might start doing it if we start paying more tax, but I just haven't seen the value in it. Like even extras cover, we've got extras cover, but it definitely doesn't make any financial sense. It's just because we've always had it. We've always been told we have to have it.
Wow. Okay. Yeah, third party. I think that's something that people should look at if they have a lower value car and they've got a big emergency fund. That could be something that people consider if it's actually necessary. But that's it's a different podcast, as well as the Tesla podcast. We should start our own. But mate, this has been heaps of fun. So Phil, there's a link to in the show notes for people to work with your team. I'm going through the process at the moment, and I'm happy to report back in a couple of months when it's all is said and done. But so far, so good. So thanks for taking the time to share some of your wisdom on this episode. We've got a couple more to come in this series on insurance. So really appreciate it, mate.
Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.